that Tony Cousins is coming through loud and clear. Tony?
Hi, I'm here.
Oh, Tony, I'm glad to have you. I got some panic message 30 minutes ago saying that your colleague Phelan was going to present, then it was Lars, and eventually you had a guy at your house fixing the internet, and you are here with us today, so we're very fortunate to have you. Yeah, thanks for joining us, Tony.
No problem at all. Yeah, he brought a big hammer with him and got it working again. I think we're having a heat wave here, so I don't think our infrastructure can cope with it. But we got it going.
No, I lived in the UK for about 8.5 years or so, and I remember you would get a leaf on the rail, and the whole railway system would come down. So I appreciate the way the measures that you've gone to join us today. And I don't want to pick on your age, but I know you've been managing global multi-asset portfolios for over 2 decades now. I was going to make a joke about Phelan and Lars stepping in because we have something called the bomb squad in South African rugby where the reserves come in and outperform the starting 15, but we have the starting 15 player with us today. And so we look very much forward to hearing what you have to say. I believe, and I want to get this correctly, the title of your presentation today is The Importance of Keeping Your Powder Dry, which almost evokes feelings of a Hollywood Western as opposed to a fund manager report back. But that's enough from me. I'd like to hand over to you, and I'll catch up with you in about 10 or 15 minutes or so. Thank you, Tony.
Okay, well, thank you very much. Good morning, everybody. Yeah, my name's Tony Cousins. I'm CEO of Pyrford International, here to talk to you about the Nedgroup Global Cautious Fund, which is managed by Pyrford through our Global Absolute Return strategy. I've actually been managing this stuff for 3 decades rather than 2, so that's very flattering to be thought to be a bit younger than I am. The importance of keeping your powder dry is the title today. Some of you may have heard me speak before, and you may have heard me say that at Pyrford, rule number 1 in investment is do not lose the money. If you are trying to generate a steady real return from investments, you need to avoid big drawdowns in value, and this strategy, which is unconstrained, very liquid, has been very successful in doing that. Before we get on to that, let's talk about quarter 2. Pleased to say we produced a positive rate of return. All asset classes contributed towards that. Equities making by far the largest contribution, but bonds also delivering positive rates of return, as did our currency hedging positions. US dollar weakness was important during the quarter. We run the overseas unhedged currency exposure here between 0 and 45% of the portfolio, and we are right up at the top of that. I think it's 43.6 at the moment, on the basis that the dollar remains a very overvalued currency. In terms of what perhaps didn't go right, the long duration of the bond market did outperform really after a disastrous first quarter when yields rose quite sharply on inflation fears. That reversed somewhat in the second quarter, so our low duration positioning was not as successful in making as much money as it would if we'd had a longer duration. The lower allocation to equity markets, which I'll come on to talk about, that was a little bit of a drag on performance. We could have made more money if we'd maintained a higher equity weighting, but we have very good reasons for this. And we also saw a resurgence in growth versus value within equities. We are a value manager. We think value is very cheap relative to growth stocks. But when growth has a rebound, as it did in the second quarter, that's going to show in the performance numbers. Okay, so moving on to where we are today, market outlook. I think, as you heard from your last speaker, valuations are very stretched. This slide looks at the price earnings ratio on the global index. We felt that equities were pretty expensive moving into 2020 when they were selling at about 20-21 times earnings. They fell very sharply during the initial stages of the COVID crisis, down to 15, which gave us an opportunity to increase equity weightings quite markedly. However, since that point, equities, as we all know, have risen very sharply, far faster than earnings, and we have seen a big expansion in valuation. As we've emerged from the COVID crisis, or begun to emerge, there has been a rebound in earnings, and that's what you can see in that last downward leg in the PE, as earnings have recovered. But they are still at an eye-wateringly high level, 27 times earnings, which is a very concerning number. When we look at dividends, a very similar picture. In going into 2020, global equities yielded 2.3%. That was boosted to 3% with the market falls, and that was the point at which we increased equities. But since that point, yields have dissipated, dividends have been cut, markets have gone up, and that leaves us at a fairly derisory 1.7% yield. Note there has not been a big increase in dividends associated with the recovery in earnings yet. So this is probably even more alarming. Now, this has been led by the US market. On screen now, we have Warren Buffett's favorite measure of valuation, which is the market cap of the S&P 500 relative to US GDP. Boy, does this look stretched. We are now well outside 2 standard deviations against its average, which is just a signal of how overvalued relative to the size of the economy US equities have become. And as we see, this has been led by growth sectors of the market rather than value. We plotted this against the 10-year bond yield. A lot of these growth stocks don't make a huge amount of money today, but they do have the pot of gold at the end of the rainbow some way in the future when they promise to be making you a lot of money. Now, if you discount that pot of gold back to today's valuation, that is at a low rate. That's the importance of the 10-year bond yield. That's what you can use to try and justify some of these valuations that are prevalent today. When the bond yield rose, as it did, particularly in the first quarter of 2021, these growth stocks gave up some of that outperformance. But similarly, when yields fell back in the second quarter, we saw a little bit of a rebound in growth. So moving to portfolio positioning. This is what we've done in this portfolio. Remember, this is a capped equity weight portfolio by regulation. As equities fell very sharply in March 2020, we increased the equity weighting. As they recovered much faster than earnings and dividends, we reduced that back in June. And then earlier this year, as markets continued to rise, we reduced it again. So we are now running a very low equity weighting in this portfolio of 20% because we are so concerned about the valuations that are prevailing. Valuation is not a great timing tool in terms of market positioning, but there's plenty of evidence to show that valuation does matter. If you buy equities when they are very cheap, your subsequent returns will be way better than if you buy them when they are very expensive. Moving on to the detailed positioning of the portfolio, and this is quite a busy slide, so I'll spend a bit more time on this. You can see that the equity weighting is 20% split between 8% in US equities, 12% in non-US equities. Within the equity weighting, there is a huge favoritism towards Asia, excluding Japan, as you can see with our positions in Singapore, Australia, Hong Kong, Taiwan, Malaysia, and Indonesia. This is a theme that we've pursued for many years, the inexorable rise of Asia within the global economy. Asia within our investable universe is the region with the best economic fundamentals. It has the best demographics, the best productivity growth, the highest savings ratios, and lower debt penetration. And this economic growth, superior economic growth that's being generated in this region, this is the top line, the revenue line for the companies that operate there. And this is the following tailwind that, frankly, the Western world used to have when nominal GDP was growing in the mid to high single digits. which it isn't on a sustainable basis anymore. Asia still has this, and we are reflecting that within the portfolio. Moving on to bonds, we have both non-US bonds and US bonds in the portfolio. None of these bonds yield you very much, and they can't make you a lot of money, but because we have a very low modified duration in the portfolio of 1.3 years, this is the right-hand side top line of the bond currency portfolio information box. These bonds cannot lose you a lot of money either. We are very concerned about bond yields. Real bond yields are negative to the tune of 3 to 4% around the world. Now, some of that is reflecting beliefs that inflation may be transitory, but even if it is transitory, that is just not enough. These bonds simply do not give you enough nominal or real return, and at a long duration level, these constitute a return-free risk. You cannot make a lot of money off of them, but you can lose a lot of money, and we protect our clients and investors by adopting this very low duration portfolio. Remember, duration is a measure of a bond price's sensitivity to any given change in yield. Moving back to the equity portfolio, the characteristics of our equity investments remain as they have always done during our more than 30 years of history. This is what an equity portfolio at Pyrford always looks like: significantly higher dividend yield than the market, much lower debt to equity, and significantly higher return on equity. And this is what we believe is the magical combination for equity investors. If you can buy a portfolio that's more profitable than the market, more profitable without having to use a lot of debt to get there, and you can buy it cheaper as represented by a higher yield, then that in the long term will grind you out a better rate of return than the market as a whole. Final point probably to make here is the non-US currency exposure. I mentioned it earlier. If we didn't do any hedging, the non-US dollar currency exposure will be 57%, but we have a risk parameter of 0 to 45, and if you have a risk parameter, you must stick to it. So we do hedge the least cheap currency, which is the Australian dollar, back to the US dollar to bring us back within that risk limit and bring it down to 43.6%. However, that still reflects the fact that the US dollar is a very expensive currency. We use purchasing power parity, and as that anomaly corrects itself, there will be money to be made having money outside of the US dollar in other currencies such as sterling and the euro. So I'll stop with that, but very happy to answer any questions that you may have on how we're managing the money for you.
Fantastic. Thanks so much, Tony. This is probably the point I must come clean and say I do have some personal monies in the fund. So I was paying close attention to some of that asset allocation, and I see there's about 80% in bonds, and that's obviously US and non-US bonds as well. Just looking at those top names, it seem to be in the sovereign space. So given your views on inflation and where sovereign yields are currently at, what do you see as the main driver of absolute returns going forward on the fund?
Well, I think we return back to this theme of don't lose the money. It's lovely to be able to talk about positive rates of return, and I think the currency will generate positive rates of return. I think the particular equity exposure in Asia will generate positive rates of return, but we all know that markets can also have negative periods. And the key is to avoid drawdowns during those negative periods. So if valuations in equity markets correct, there's a lot of money to be lost. And by holding very high quality, low debt, good value defensive equities, you will limit that downside. Similarly, in fixed income, the duration on a 30-year bond is about 27 years at the moment, and so if yields go up just 1 percentage point at the long end, you're going to lose a great deal of money. You really have to be very careful here. And the history of this strategy is that when risk is not being priced correctly, you go and hide in the cave. You protect your client's capital, keep your powder dry, and have more money to redeploy into risk assets like equities or longer duration bonds once those valuation anomalies have corrected themselves. So, I didn't come on today to depress everybody, but I think it's just there are times in market cycles when you need to be very wary, hang on to what you have made, and don't lose it. And that's very much the focus of what we are doing right now.
Thanks, Tony. I guess sitting here in South Africa, a big part of our psychology and thinking is the offshore portion of our investments, given a lot of the uncertainty we're getting here locally. But if you do have the stomach for it, I know a sovereign bond that will yield you double-digit returns here in South Africa.
Yes.
But on that note, I guess maybe time for one more question. And I must confess, my colleague Doug Nicol, who's the product specialist on your fund, did send me a few questions. And he is for lack of a better word, a fixed income nerd. And the questions he sent me, I could barely understand. But he did mention, and I went back and listened on some of your previous workshops, you mentioned financial repression. So maybe just a quick explanation of what that is for the audience and clearly for myself, particularly in the context of the US. And I guess just the back end of that question is, what does that mean for the US dollar from your currency point of view?
Yeah, sure. Well, financial repression, I mean, this was used after the Second World War. It's basically the authorities and the central banks in particular holding down yields on fixed income instruments to essentially give investors negative real yields while governments get out of debt holes. Now, governments around the world, to differing degrees, are in some terrible debt holes. Japan, in particular, peripheral Southern Europe, also is in terrible debt holes. And it's not just the Fed. The ECB, the BOJ is doing this as well, even the Bank of England, keeping rates well below the level of inflation. And in terms of in the case of the ECB, keeping nominal rates negative, which has some very distorting effects on the economy. So that's what financial repression is, not allowing rates to find their natural level driven by inflation. Now, if the Fed was doing this on its own, I think this would be particularly negative for the US dollar. However, they're not. And if anything, you'd probably say that the ECB and the BOJ, Bank of Japan, are being more aggressive in this effect. But what we have here is, because the way to get out of a big debt hole is to inflate out of it, is central banks changing their tune about their attitude to inflation. We've seen the moving to average inflation measures, to making comments about allowing the economy to run hot without responding through monetary tightening and interest rate increases. And also, if you really want to get technical, allowing the money supply to grow very, very fast. Monetary economics isn't as popular as it used to be, but still has some merit, and we've seen big increases in monetary growth. So there was a clear bias in authorities and central banks towards expansion and keeping rates much lower than they would otherwise be given the economic fundamentals, and that's the financial repression, not giving people a fair yield relative to the levels of inflation.
Brilliant. Thank you very much, Tony. Appreciate your time this morning.
Okay, very nice to see you. Thank you all for your attention.
Take care.